Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for February 2025. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So we'll start off with December 2024. We actually haven't released our performance for the end of last year, so here it is in a slide. We finished 2024 pleasingly. With a return of 3.7% versus the index of 2.5%, and continue to run at a very healthy run rate since inception of 17.1%, outperforming the MSCI World Net Index by 1.4%. Over December, we basically sold our position in MasterCard and reduced holdings in Amazon, Alphabet, Brookfield, and Microsoft, bringing the total number of stocks in the portfolio to 12, and cash to about 19%. We also started 2025 well. This is the performance table for January 2025. We returned 4.7% versus the market, versus the index 3.2%. And again, running at a rate since inception of 17.8%, outperforming the market by 1.7%. Over January, we basically deployed some of our cash and increased our weighting in Taiwan's semiconductor manufacturing company to have 12 stocks and around 17% cash. The performance of our portfolio is basically plotted here. The cumulative performance of our portfolio here is plotted since inception versus the index. And you can see again the 17.8% per annum since inception versus the market as we define it at 16.1%. So for today, I thought I would just basically update, I guess, our thoughts on the Trump presidency, the first few weeks of it. Obviously, we basically talked about the impact of Trump's election at the end of last year, and in the end, realistically, President Trump has been doing what he basically pledged to do, and that is essentially putting America first. Essentially, the impact, or the devil being in the detail, has basically seen the S&P 500 basically stuck in a trading range the last month, and this is essentially the market is just trying to digest the impact of tariffs, the threat of tariffs, or trade wars, in terms of what it means for the political backdrop and investment environment. Inflation continues to remain persistent, and obviously Trump's actions could add a potential additional fillip to that, and obviously disrupt global growth and slow global growth. And this is obviously being reflected in the bond market, with yields basically backing up. Obviously, with investors being concerned about the future corporate profits. Obviously, as we always continue to say, that share prices drive earnings. Sorry, other way around, I should say. Earnings drive share prices. There's some worry about essentially what it means for near-term profitability, and the ability to basically raise the market from its current level, where it's trading on a 12-month forward P of around 20 times versus a 10-year average of 18.3. So essentially, the market is not screamingly cheap, but if you look at it on an equal weighted basis, that's a little bit different than what we're seeing at the moment. There are several large stocks. Tesla I sort of talk about here, which is trading at 92 times earnings. A lot of blue sky for autonomous driving vehicles, which essentially aren't being backed up yet by earnings. So essentially, and also, as I mentioned before, or in the last year, with Trump pulling a lot of fiscal levers and a lot of his policies being potentially inflationary, the outlook for the level of monetary easing has been reduced moving forward globally versus basically before his presidency at the end of last year. So I'd also just thought I'd touch on reporting season instead of sort of talking about a stock in particular. So we're pretty much coming to the end of the fourth quarter reporting season. Just over 3/4 of the companies have reported earnings in the S&P 500. 3/4 of these companies have beat earnings, which is a little bit less than the 5-year average of 77%. And also the earnings beats have been a little bit below average versus 5 years, where it's 7.6% above consensus versus an average of 8.5. In saying that, it's been a very good quarter for earnings growth. So thus far, with 3/4 of the market basically reported, it looks like earnings growth year on year for the quarter is just under 17%, which is the highest since the fourth quarter of 21, and the sixth consecutive quarter of year-on-year growth. Essentially, looking forward, with the market commentary and what analysts are basically pricing in post company reports, it looks like 2025 earnings growth for the S&P 500 is shaping up to be around 13% or a little bit under. The same story is for revenue. 66% of the companies have basically beaten expectations on revenue growth, below the average of 69%, and also the magnitude of the revenue beats of 0.8 is also below the average of 2.1%. And saying that, it's been a good quarter for revenue beat year on year. I think the 17th consecutive quarter of growth. What's actually been interesting though, with the level of pricing of some of these stocks, that the smallest level of disappointment on either earnings or revenue, or basically cautious guidance on outlook, has seen some of the stocks absolutely savaged by the market. The market basically does not like uncertainty, and it needs news flow to basically drive some of these stocks higher moving forward. So this essentially sort of, I guess, evidences or supports the backdrop of the portfolio at the moment, where we're running with a bit of cash. So cash, as I said, started the month, or January, around 17%. It's a little bit lower given the performance of the portfolio. It's running around 16 or 16.5% at the moment. But look, we're keeping a lot of powder dry, as I said, because the market is not screamingly cheap, and there's a lot of uncertainty at the moment in the market with respect to policy moves and policy responses. And the market basically does not like uncertainty. So it's very much a case-by-case basis, a stock-by-stock basis, looking forward. And while the market is at least, well, on the whole, well-priced, our portfolio basically, we continue to see value in the stocks that we hold. Anyway, this is the end of the update. As always, please feel free to either contact Tony and myself. Our contact details are at the beginning of this presentation, and failing that, I will be basically back in the month to give the update for February 2025. Thank you very much.